listeners, I am joined by John Pierre Vesta, the CEO of Protea Capital Management Fund. And he'll be here to talk to me about, or to talk to us really, about how he manages money, or his tricks around managing money, growing money, and also protecting money. JP, welcome to Master Your Finances podcast.
Thank you, Caroline. Very nice to speak to you.
Lovely. Just to kick us off, if you can just give us a bit of background around where you come from. Where is your hometown?
Sure. So I was born in my hometown, where I also went to school, is Pretoria. But I've now been in Johannesburg for, I think it's roughly 17 years. So sometimes I do feel like Johannesburg is almost my hometown these days. But I was born and bred and my schooling was in Pretoria.
Wow, 17 years. You're almost an adult, eh? If a child was born 17 years ago. So JP, yes. What was your dream career when you were growing up?
I don't think I had a particular dream, but I've always had the intent to live a life that I enjoy and where I can make a positive impact on other people's lives as well. So one can maybe perhaps say that is the dream in the broader sense of the word.
Wow. So JP, who or what inspired you to reach for the stars?
Well, because I wanted to live a life that I could enjoy and make a positive impact on other people, I read widely and I came across investments as a career. And that showed me that is a career where one can enjoy yourself and make a positive impact on other people. So who inspired me in particular is Warren Buffett. I read about Warren Buffett. He was born in a middle-class family in 1930. And just through very good investment decisions, he is today one of the wealthiest people in the world. Now he is, let me do quick maths, 89 years old. So he's had a long period in which to employ good investment decisions. But having read a lot about him and his letters to shareholders and the logic and the rationality that came through really resonated with me. And that inspired me to then emulate that and also go into investments.
Wow, JP. So more or less, at what stage in your schooling career were you clear about investments?
Well, at school in matric or grade 12, as it's called these days, I took 13 subjects because I had a very wide interest in all kinds of different subjects, from maths to science to all kinds of different subjects, whether the hard sciences or more softer subjects. And at that point, I wasn't quite clear what I wanted to do. At university, I knew that studying to become a chartered accountant would open a lot of doors for me. But even then, I wasn't quite sure exactly what specialization within chartered accountancy I wanted to go in. I just realized, and I heard from other people, that accounting is, call it the language of business. And you need to be able to read a balance sheet and an income statement if you want to be, call it business literate. Yes. And then through my studies, I read more about investments, as I said earlier, and Warren Buffett. So by the time I would say I had finished my studies, so this would be roughly 2004, 2005. At that point, I knew that investments was what I want to focus on and that I want to build a career in.
Well, I must commend you there, JP, because a lot of people aren't actually clear, even as they finish their studies, what their dream career would be or their long-term career would be. So that would almost suggest that you found your purpose earlier on in life. So well done for that.
Yes. Thank you. Yes. And it is a blessing. I do realize that because a lot of people only find their purpose quite late in life. So I was lucky or fortunate enough to find it quite early and then work very hard towards it and try and attain it and build a career in what is my passion. And that is where I'm sitting today. I'm 38 years old, so I'm still young. I hope people would see me as young. I think 38 is young.
Life only begins at 40.
There you go. Exactly. I agree with you, Caroline. But I found that intersection between your passion, your skill, and your purpose, and that is why I think I'm doing quite well in what I do, because it's that intersection of all those different preferences, and that's why I'm very comfortable, very happy where I am today. But I'm also looking forward to the next, I don't know, hopefully if my health keeps up, the next 50 years of doing what I'm doing today, and that is investments. I really look forward to continuing this focus on this career path.
Well, JP, Master Your Finances definitely will be tracking behind you to see what you're up to and the new methods, etc. So we're looking forward to that, because it seems as if it's a gray area. A lot of people don't quite understand what investments are. So we'll be exploring a bit more into that further on into the podcast. So just to close off this section, what would you say, or would you say there was a turning point in your career, or is that what you've already shared with us?
Yes, now the turning point, or what I say, what really focused my mind to say investments is the thing to go for, was when I was studying at university to read about Warren Buffett, and that's where I decided, yes, this is the investment, this is the career I want to focus on, investments, yes.
So for you, it was earlier on. So once again, kudos for that. So what's currently driving you today?
Well, I enjoy what I do, and if one does it well, you can also make some money, which is which is helpful. Money gives one choice. The more, if you have sufficient money, you have more choices in life. So, look, there's a point at which you can say what is enough and how much more money do you need to earn.
Yes.
The amount you need and what is then in excess. But if you enjoy what you're doing, it's not about the money. And I am enjoying what I'm doing, and we'll get into my business in a minute, but it is a relatively young business. So
yes.
We're not making that much money yet. But the point is that because I'm enjoying what I'm doing, that drives me.
That actually drives you. So anyway, so let's not wait, right? Don't keep us waiting. So maybe then give us a brief history on Protea Capital Management.
Sure. So Protea Capital Management is a investment business. Our focus is on hedge funds. The business has got 3 registered hedge funds, and we'll get into hedge funds and what that means a bit later. But we got our own financial services provider license in May 2019. So the Protea Capital Management business is relatively young. But in effect, the business was in a joint venture before May 2019 with Fairtree Asset Management for 3 years. So I have been managing the Protea range of hedge funds actually for roughly 3 years now. And before that, I got my experience at other asset managers, including 361 Asset Management and Melville Douglas Investment Management. But the Protea Capital Management business is now only 6 months old, although it feels a lot longer and a lot older. Because we got our own FSP license quite recently.
Oh, congratulations on securing that license. Okay.
Thank you. It took almost a year. It's quite rigorous, the regulatory process to get your own license, but that is how it should be. Because
that's how it should be. I agree.
Money from the public, exactly.
Yes.
The public needs to have trust in people that market to the public, that are allowed to take money from the public and invest it. So it should be rigorous, and it was rigorous. It took us the better part of a year to get the license.
Wow. But congratulations all the same. And it is comforting to know that, people can place money with people that they can trust, and that there are people watching what you do. So that's actually really encouraging. So JP, who is your ideal customer?
Well, traditionally, an ideal customer or client for a hedge fund would be a high net worth individual or a big institution, because historically hedge funds were seen as complicated, complex, and sophisticated investment funds, and therefore only available for high net worth individuals. Now, in the last 3 to 4 years, the regulations in South Africa have changed, and hedge funds today are regulated as any traditional long-only unit trust would. A hedge fund is a unit trust in South Africa. It's just a specific type of unit trust. Right. So what that means is, like 2 of our 3 hedge funds, for instance, are retail hedge funds, as the regulations refer to them. And that allows us to drop our minimums to a relatively low level. Still, for people who have got savings, who have got some money left at the end of the month, our minimum for a monthly investment is only 2,000 Rand per month. So our ideal investor has got anything from 2,000 Rand per month or more. We have investors, and our third fund is a qualified investor, where we have investors that invest a minimum of R1 million. Right. So we can sign up clients anything from 2,000 Rand per month to over R1 million. But our ideal client is one that focuses on the long term, that understand that share prices go up and down, equities are volatile, and they trust us to manage their money and generate returns from them over the long term, and they are patient to wait for those returns and trust us to generate those returns for them over the long term.
Okay, so you're starting to mention the long term, right? So how long should a person invest in order to benefit from, the approach that you are applying in your hedge fund?
The longer the better. When anyone invests in equities, the longer the better, which also means the sooner you start, the better. So what we tell people, for you to assess if your manager, your equity fund manager or hedge fund manager is doing a good job, you should give them at least 3 years, but preferably 5. So 3 to 5 is your minimum. But actually, it should be much longer than that. But after 3 to 5 years, you can start measuring them and comparing them to other funds that follow similar strategies or are exposed to similar risks to then decide if your fund manager is doing a good job. At least 3 to 5 years, I would say.
Okay, so 3 to 5 years. I think that's reasonable. So what would be the most appropriate product then for this approach? So is it for retirement products? Is it for tax-free products? Is this for discretionary investments? What sort of product would you say is most suited to the hedge fund approach, particularly your hedge funds?
So there are a few interesting regulatory requirements when it comes to hedge funds or people's allowed exposure to hedge funds. The first one is that the act that deals with retirement money, which is called Regulation 28, sets certain maximum exposure limits to different types of investments. And there is a limit that Regulation 28 allows for any retirement money to be exposed to hedge funds, and that is 10%. So any Regulation 28 money, whether it's a pension fund, a retirement annuity, or other Regulation 28 pools of capital, is only allowed to allocate up to 10% to hedge funds. The other point to mention is that a tax-free savings account, normally they are set up that they do not allow funds that charge performance fees as an option in a tax-free savings account. And the regulation actually has also said that hedge funds themselves cannot be offered within tax-free savings accounts. So that also means that you can't access or invest in hedge funds via a tax-free savings account. So what is left then is discretionary investments. And that is where hedge funds come into their own, and that is how you can access hedge funds. So discretionary investments mean it's discretionary. It's after you've paid out everything you wanted. It's after your mandatory contribution to a retirement fund. The money you have left over in your bank account, that discretionary money, that you can consider to invest in a hedge fund.
Okay. Now, thank you for that, JP. And so are there any tax considerations that would be different in this particular case?
So because hedge funds are regulated as collective investment schemes, which is just another word for unit trusts, hedge funds are also unit trusts. So the tax laws regarding unit trusts is also the tax laws applicable to hedge funds. And basically what the tax laws say is that the trading within the hedge fund, your long-term capital gains that the hedge fund within the fund generates, does not trigger a tax event for the investor of the fund when the fund manager sells a share. It's only when the investor withdraws from the fund that they would then pay capital gains tax if they held the fund investment on the long term on the capital account. They would pay capital gains tax when they withdraw the investment from the fund. So it is a vehicle that's tax efficient for long-term savings. You invest in a unit trust, whether a long only or a hedge fund, and you only pay tax then at the end when you withdraw your investment. Sometimes within the year, there's a small amount that gets passed through to you in the form of a dividend or interest that might have a small tax effect. But the major tax effect, which is the tax on the gains that the fund may make, those gains are deferred until the date that you exit from the fund.
Okay. And okay, so we've spoken about the tax. What about the costs? So what are the costs associated with the hedge funds?
So if you invest directly in a hedge fund, so you go to the website of the hedge fund manager, you fill out an application form, you transfer your money straight to the bank account of the fund, the hedge fund, there should not be any upfront fees. If you make use of a financial advisor, the financial advisor might charge you an upfront financial advice fee. But if you make the decision yourself to invest in a hedge fund, there's no upfront fee. You only pay the fees charged by the manager. Now, the fees of the manager normally in a hedge fund is split between two types of fees. Your basic management fee, as it's called, and then a performance fee. Now, your basic management fee for a hedge fund on average is roughly 1%. Internationally, it's 2%, but in South Africa, the average hedge fund charges around 1%. And that is in line with a lot of active managers in traditional long-only unit trusts. Then in addition, a hedge fund manager charges a performance fee. And the different hedge fund managers have structured the performance fees slightly differently, but the whole idea of the performance fee is to align the interest of the hedge fund manager with that of the investor. And only if the hedge fund manager delivers an above average return would a performance fee be levied. Now, what that means is if a hedge fund has a year that it does very, very well,
Right.
it would charge a higher performance fee because it has performed. And then the fee would look significantly above average, especially when compared to passive investments like ETFs.
Yes.
But the important point is that your return, even after fees, will be above average with this performance fee structure. And therefore, even after a higher than average fee being paid, you can still earn a higher than average return because the high fee is just because of the fact that the hedge fund manager performed. And that is exactly what happened last year, Caroline.
Okay.
The Protea South African hedge fund,
Yes.
which is one of the hedge funds that I manage, was the best performing retail unit trust in the country for 2018. That's out of all
Well
long-only
done.
managers, all hedge funds. Thank you. And the fund, before fees, did over 30% in terms
Wow.
of its return for 2018. But because of the performance fee, the investor only received a net return of 24%.
Right.
Now,
But 24% is
24%,
still sounds
it
really
was the
good to
best in
me.
the country. Exactly. The JSE All Share dropped by over 8% in 2018.
Yes.
Our Protea South Africa fund delivered 24%. But a lot of advisors and a lot of passive fund providers say, don't focus on the 24% net return, focus on the 6% fee, performance fee that the manager took.
But I mean, to
And
me,
that
it
is-
makes sense, right? Because you're giving them a return of 24% when the JSE did, you said a negative 8%.
Yes,
So I really don't mind you taking the other 6%.
exactly. And
Actually.
that is the narrative, the negative narrative that the passive industry has tried to create, to say, don't focus on returns. You don't know which manager is going to perform above average in future. So just focus on the fund that has the lowest fee structure. What I'm saying is there is a small handful, it is a minority, but there is a small handful of fund managers that have exhibited that they do have the skill to outperform. And that's why they charge an above average fee if they perform in
If
terms
they
of a
do
performance fee.
outperform.
But you can still get an above average return. And if they don't outperform, there won't be a performance fee. And then the total fee won't be above average. It's only above average if the fund manager outperforms.
Okay. No, that sounds very interesting. And I think it sounds fair. You charge the normal 1%, which is what the passive, do the passive investments not also charge around 1%?
If they're bigger, a bit less, they might charge around 65 basis points. But other
Okay.
active managers would charge roughly 1%.
1%. Okay. No, thanks for that. So, JP, at Master Your Finances, we believe in, as we teach people on personal finance, we tell them to manage or we teach them to grow and protect. So it's that three-pronged approach that we focus on for you to be able to build wealth. So coming back to you, what are the most important aspects that you deem are quite important when it comes to managing personal finance?
I would say in terms of managing your personal finances, the number one thing is to have self-discipline.
Right.
And together with that, to be able to delay gratification. So if you want something now, and it's a consumption item, it's a new car, or it's clothes, or it's a nice night out, or whatever it might be, it's not an asset, it's not something that will appreciate in value, it's something that you are consuming. Think carefully if you really need it right now, or whether you can defer the gratification, the enjoyment of that you're going to spend your money on. And if you can defer a lot of the gratification and not make emotional decisions with your money,
Right.
and have that self-discipline to actually spend less than what you earn, that will put you in a position where you then have excess money at the end of the month and you can invest that money for the long term. And then over the long term, if you keep on investing every month your excess money that you have because of your self-discipline, you can have a very nice investment that will grow for you over the long term, and your future self will be much happier and you will be able to consume a lot more in future, in 10 or 20 or 30 years than you can today by using that money.
Right. Thank you so much for those pearls of wisdom. Okay, now we go to growing, right? Wealth, because it's not enough to manage, you also need to be growing. So maybe share with us, what are the most important aspects of growing wealth to you?
Well, personally, I've come across this quantamental way of managing money, of combining qualitative ways of looking at companies and more quantitative, automated ways of crunching the numbers and deciding what is fair value. And that allows me within the hedge fund to buy shares I expect to go up in price and short shares I expect to fall in price. And over the long term, what I have already generated for our fund investors, and before that, before the Protea funds in other private vehicles, was to grow the money at an above average rate. So my specific approach, and like I said, this is from the perspective now of a fund manager, is employing a quantamental approach allows me to grow the wealth of my outside investors. And as long as they stick with the fund and trust the fund manager to do that over the long term, even though there might be a little bit of volatility in the short term, then it means the outside investors' money will also grow at an above average rate when they back that fund manager.
Okay, and are you able to share with us, say, for the past 3 years? You said your funds have been operational for three years.
The worldwide fund is just over 3 years, and the other two are just under 3 years as Protea hedge funds. Yes. So, for instance, the Protea worldwide fund, let me have a quick look. Over the last 3 years, it has delivered just over 30% after all fees, while the all share has delivered 22%.
Wow.
Over the last 2 years, it's delivered 26% against the all shares 2.5%. So significant outperformance since we launched the funds. And importantly, that's after fees, and it's even after above average fees.
Wow. That sounds really interesting, JP. And I can believe you, because you're purpose driven, you're doing this for the love of it, and you actually, this is your purpose, right? And you get to make a difference in people's lives. So that's actually really, and I actually think that, getting solutions like the one that you're offering may actually take us a step further in solutioning for the retirement problem in South Africa. You know that less than 8% of people can afford to retire comfortably. So, and one of the ways in which we can actually resolve that problem is to get people to save more for retirement. So that's really encouraging, JP. Thank you for that.
Definitely. I agree with that.
Okay, so my last question is around protection of wealth. So what are your pearls of wisdom around, wealth protection? How should the everyday people, ordinary people, like you and me, go about protecting their wealth?
So the term protection for me is always used in relation to danger. You want to protect yourself against danger. And in financial terms, I would say that if you invest in a fund, the one danger is that in the short term, you can have negative returns. And that is where a hedge fund has got a role to play to hopefully negate a lot of the negative returns and give you a smoother return so that you don't get a fright and withdraw your money at the wrong time. But then more broadly speaking, the other danger you have is unforeseen circumstances. Your house can burn down, or your car can get stolen, or you can get very sick. And that is where insurance comes into the picture. So I would say more broadly, to protect yourself, your financial well-being, your physical health, and your assets, it's always important to have insurance so that if something untoward happens, you are not in distress. You are not put in an impossible situation. So you have insurance for those events, and then within your investment funds, maybe consider hedge funds that give you a smoother return. Or then if you do go for a long-only equity fund, don't get a fright if it gives you a negative return, because that happens over time in the short term in equity markets.
All right. Thank you so much, JP. Are there any final thoughts from your side?
I think that's it. If anyone is interested, they can go to our website, proteacapitalmanagement.com. We're also active on social media. And like I say, like you said, our purpose, what we want to do is grow people's wealth over the long term. They can see the application forms on our websites, and hopefully we can help them and grow their financial wealth over the long term by managing their money well.
Thank you so much, JP.